Perfect. Ankit, we are live now. We can start.
You can share the screen, Eesha.
You can't share the screen. I will share it for you, but you can start in the meantime.
Yeah, you can share the screen.
Yeah, I've shared my screen. You can see it, Ankit.
Yeah.
Perfect. Perfect. I think Ankit, you're not completely audible. Need to increase. If you could come closer to the mic.
Okay. Is it better?
I think so. Yeah, you can start.
Yeah. So welcome everybody to Gulaq September AMA webinar. My name is Ankit Kejriwal. I am an analyst at Estee Advisor. The original speaker for today's webinar, Mr. Vivek Sharma, who is the investment head at Gulaq, and most of you would have already seen him in previous webinar. He could not attend this webinar because of some unavoidable family emergency, and therefore, I would be moderating this interview, and Eesha Gupta, who is the business manager at Gulaq, and a lot of you would have already seen her in previous webinars, who would be taking you through the slides of past month's changes and a rundown on the numbers of returns.
Okay.
So we'll be talking about ST and Gulaq, and then we'll move to the recent changes in the portfolio, what were the returns, and how we have shifted our allocation across market cap, sectoral, and how we have performed all the different years. And lastly, we'll take questions that some of you might have. So ST Advisor is a systematic quant-based firm in India. It has over 15 years of experience in building sophisticated investment products for mostly for institutional and high net worth individuals. It was founded in 2008 and operates in over 6 countries. It has also won an NSE Institutional Member of the Year award in 2019, and the cumulative AUM under the firm is over 1,500 crores. Gulaq is the retail advisory arm of ST. It uses the same sophisticated quant algorithm that ST uses for high net worth individuals uh, uh, and institutional clients, and we package those research into a product that could be sold to retail clients like yourself. It was launched in 2020. We are a SEBI registered investment advisor, and so far we have served over 20,000 happy customers. So our core team consists of 3 people. A lot more people work behind the scenes, like myself. The founder and CEO of Estee and Gulaq is Mr. Sandeep Tyagi. He is a BTech from IIT Delhi and holds an MBA from Columbia Business School. He has over 30 plus experience in portfolio management. Next, we have Mr. Vivek Sharma. He's the investment head at Gulaq. He holds BTech and MTech from IIT Kharagpur and has 20 plus experience in trading and investment management. Lastly, we have Eesha Gupta, who will be taking you through the slides. She's the business manager at Gulaq and holds an MBA from Indian Business School. She has over 6 plus experience in consulting, research, and financial services. So, a disclaimer alert: ST Advisor is a registered SEBI registered investment advisor, and all investments in security markets are subject to market risk, so you should read all the documents carefully before investing. You can visit small case and click on that methodology button to know more about how we invest and a rundown on the numbers. Next, like Eesha would be taking you through the last month's portfolio changes and rundown on the returns of the portfolio last month. Over to you, Eesha.
Thanks a lot, Ankit. Hi, everybody. Thank you so much for joining us today. Unfortunately, as Ankit mentioned, Vivek could not join us because of a family emergency. So I'll be taking you through all the updates, answering certain questions that we received in advance in the form, and also taking the questions in the chat box today. So please feel free to message whatever you have. I already see a question from Rahul who says that it's the Gulaq portfolio is not moving anywhere. Well, Rahul, firstly, thanks for being an investor. I assume you are already an investor of ours. And just stay tuned. In the PPT, I will be talking about a lot of different things. We'll be talking about the changes in the portfolio. We'll be talking about cone of confidence, the change in the churn rate, and a lot of other data, which will help you figure out what's happening and also have a sense of how the market is doing and how our portfolio's risk and returns are as compared to the market. So, does it make sense for the portfolio to do what it is doing right now? So, just stay tuned. And firstly, to take you through the rebalance update, you will see in terms of market cap, we have not moved much. We were already heavy on mid cap, and now we have moved a little bit more, 4% from large cap to mid cap. So that's the area where we are relying on most right now. Sectoral weights, again, not a lot of change. You will see that we are more bullish on consumer staples as compared to the last month. We have also healthcare, which we have removed from the portfolio basically. So these are some basic changes as per the sectors. Looking at the factor weights, we are still, this is the fourth month from July onwards that we are still focusing on quality and leverage. And we have not changed it much, which is also reflective in the churn rate. So the churn rate was pretty low. It was under 40% this month, which you may have seen. So, like we promised, we were working on an upgraded version of Gulaq in which the churn will be lower, and that's what we have delivered as of now. Let's just a quick update on all the four products we have for the people who are newly associated with us. We as a company always insist that you should do your risk survey, and based on your risk appetite, you should park your money in the relevant portfolio because you will see all these gears are corresponding to different risk levels. So feel free to just rewind the live and see these products that we offer, which are also visible on the platforms where we are present. Now coming to the returns, I understand you'll see something in red here, and you will be wondering what's happening. So the benchmark multi-cap index has given this much, whereas our portfolios have given this much. This is the overall performance as well since 4 years. Similarly for Gear 5, 4, 3, and also a consolidated view of all the portfolios with the benchmark. Benchmark, of course, is 100% equity. So for an apples to apples comparison, this is more suitable to be compared with Gear 6. I'm moving through them quickly because you can always rewind and see these numbers if at all. Again, the overall performance, it has been going up. If you see in the calendar year overall in 2024, we are still up above the benchmark. And 100 rupees invested in May 2020 would become 321 in the multi-cap index and 757 in the in Gulaq portfolio. One important factor I would like to point out is that when we look at the benchmark results and when we look at the Gulaq returns, we say, hey, whatever you are quoting is not the actual returns that we are earning because of certain transaction charges, fees, etc. Similarly, in case of Nifty Multicap, if you are to clone that strategy and invest in the multicap index, there will be similar charges. So pre and post calculation of returns, it should be somewhere around the same levels. So I'm letting you know this so that you don't end up comparing the post transaction fees results of year 6 with the stated or the reported benchmark returns. Just a tip over there. Okay, quickly about the book, I think you would have already seen that Sandeep has launched our a book which is called The Little Book of Big Gains, which is a great guide which helps you invest systematically, get rich systematically. In the book, he's talked about how to build an investment plan, how to avoid noise, how to stay the course and take it further, how to not get influenced by what is happening around you and really focus on how to plan your investments well. This is a very quick read. It has some 160, 170 pages. So feel free to go to Amazon and grab a copy. Um, Now, before I get into the questions, before the actual AMA starts, I would like to announce this particular news that came very recently, just earlier this week. This comes as a welcome change for all of us who are investing in direct equities, because earlier, as you would know, around 80, only 20% of the funds were actually credited to your account the next day. Only 80% were available on the same day of rebalance for you to invest in the buy recommendations. So, given this change, now entire 100% of your sale proceeds will be available on the same day, which means there would not be a need to, you know, go to small case the second day and do the second leg of rebalancing. That's benefit number one. Benefit number two is you won't be asked to add additional funds just for buffer sake, which was introduced by small case a couple of months back. So that is again another benefit. And the third benefit, which is also extremely important, is that slippage won't be there. Like slippage would be there, of course, but it will be lesser, because you won't be waiting till the next day, right? So slippages will also they are also expected to reduce. These are three major benefits of this welcome change that has been brought about in the ecosystem. So congratulations to all of us for this. Okay, now starting with the questions, right? When we talk about questions, there are around these four themes, and I'll be targeting the ones that we received in the form, after which we can open the house to questions that are coming on the chat box. Okay, risk and return. Now, this is an interesting slide, and I would want to spend some time over here. Someone is asking, what should we expect from Gulaq upgraded? So I will slow down a little so that you can understand what I'm saying. What to expect? As you have seen Vivek and Sandeep talk about the fact that the markets now are performing better than how they used to in the past. And what we expect is somewhere around, let's say, 10 to 12, 14% the market may give. And if we as Gulaq, as an active fund manager, if we are able to give you an alpha of 5% on top of the market, we will be extremely happy. We will know that we have done our work well. So in the long term, I'd say we expect the market to be somewhere around 10 to 12, 10 to 14%. This is my personal view as well. And if we are able to give you somewhere around 16 to 20%, that's actually good growth, which can be substantiated by data as well. So if you can see BSE 500, we have mentioned the returns for 1 year, what has been the CAGR so far. Ankit, just to ask you, you're able to see my mouse, right? I'm scrolling with my mouse and I'm highlighting certain percentages. I hope you're able to see this clearly on the screen.
Yeah, yeah, it's visible.
Perfect. Okay. So as I was saying, the 1 year CAGR is around 39% of BSE 500, which is our benchmark index. The 5 year CAGR is 21%, but the CAGR overall over here we mean 12 years, because that is the backtest data of our upgraded Gulaq portfolio. So for last 12 years, the BSE 500 has given around 14%, which is in tune with our expectations. So this is what we expect the benchmark to give you over the long term. Lately, markets have done really well, and it is also visible in the returns. Similarly, it is also visible in Gulaq's returns. So as you will see, the very first line on the table talks about our returns of the portfolio that was in place till August end. Because as you would be knowing, in September, we upgraded our portfolio to reduce the churn and optimize for churn better while keeping returns more or less in place. So as you see, the first line talks about the returns of Gulaq before upgradation. The second line here talks about upgraded Gulaq portfolio after taking into account the fees. I'm only talking about turnover based fees, not the fixed fees. So, turnover based fees, we have taken Zerodha as a proxy, and we have found out that 12 bips, which is 12,000 rupees per crore. This is like 0.12% is 12 bips. So 12 bips is the percentage fees that is charged, which includes the transaction charges of the brokers, the brokerage in certain cases. So we've taken Zerodha as the proxy. If we account for 12 bips as the fees, and we also apply it on the upgraded version of our portfolio, our returns are still better than the previous Gulaq portfolio version, even in case of 5 years, even in case of your 12 years. Now add to that the DP charges. DP charges are fixed charges that you pay on selling certain stocks. Every time you sell a stock, you pay around 16 rupees. So if we account for DP charges and we say, okay, our portfolio size differs. It is 24,000, 50,000, 1 lakh, 2 lakh. For all these different variations of the portfolio, we see what are the returns. Basically, accounting for the new portfolio and accounting for 12 bips of turnover based fees and the DP charges and these different ticket sizes, we say, okay, these are the returns. So, what you will see is that in case of Gulaq upgraded, having a portfolio of around 1 lakh puts us in a very safe position because we are still making at par or even more return as compared to the previous Gulaq version. You can see these returns for 1 year period, for 5 year period, and for 12-year periods as well. So this is the situation. And now I talk about information ratio, which is another interesting metric to look at. Information ratio is slightly better than Sharpe ratio because it measures the risk adjusted returns, but it takes into account the active returns. By active returns, I mean excess over benchmark, the alpha. And it tells you how consistently the fund manager is being able to deliver good returns. That's what the information ratio here tells you. You can look up the formula. It's very straightforward. It's something similar to Sharpe. So it's a risk adjusted return of the portfolio, uh, which tells you how consistently the manager is performing because it takes into consideration the active returns or the alpha. And typically in the investing world, an information ratio of over 0.5% is considered to be very good. So again, if we have to look at the information ratio for 1 year, it's pretty much similar. If we go to 5 years, you will see information ratio of our previous version was not as good as the new version. And again, when we increase the portfolio size, it gets better. And if you look at 12-year long period, again a similar trend, the IR was not like it is still better than 0.5 because the portfolio was performing quite well. So it's still a 1.4%. Sorry, not percent, it's still 1.4 for small case in the prior version. But when we go to Gulaq upgraded, you will see it does fall in case of a 24,000 rupee portfolio. So what we are seeing is that the recommended amount is around 1 lakh. 50,000 is also okay, but try to reach 1 lakh via SIPs to be able to get the best possible returns because the fees are of two kinds. There is fixed as well as variable. So for the fixed fees to also start making sense to you, you should have a minute like around a lakh rupees invested in this specific portfolio to start making sense of it. And that does not mean that you have to invest 1 lakh at one go because some of us may not have that possibility. We have other expenses, so we may be able to make only 10,000 or 20,000 to invest every month. That's okay. The idea is to stay invested and reach 1 lakh and then start looking at whether this is making sense or not. So back to the question, the original question is what sort of returns should we expect from Gulaq upgraded? It depends on your investment levels. Ankit, are you saying something? I can hear some sound from your side.
Yeah, so we have a question from Mondal. He is asking what about STP? So
Sec-
Mondal, it's getting covered in the 12 bits that we have taken in the third row that you're seeing small case at the rate 12 bits. So it's getting covered in that only.
because that is STT, security transaction tax, is a percentage based charge which we are already accounting for in the 12 bips. So this also accounts for the transaction charges, and in case of zero, the brokerage is zero. So the overall 12 bips includes your STT, your transaction charges, and the GST on them. There is also, I think, some semi-turnover fees. If it is applicable, it would be included. And Ankit over here is from the content side. So he's responsible for, also doing a lot of these calculations and putting together content for us, for the PPTs. He's the man who's behind the scenes working on the content, and you see him today on screen. Okay, so on this table, Ankit, is there any other question?
Not directly related, but the same person Mondal is asking what is the difference between Gulaq Gear 6 and Gulaq Wealth now that Gulaq Gear 6 contains over 30 stocks?
Right. Okay, that's a good question. What's the name of the person asking?
Mondal.
Sorry,
Mondal.
I couldn't hear you, Ankit.
Mondal.
Mondal. Okay, Mondal. All right, Mondal. So that's a good question. See, years Gulaq Wealth is something that we have discontinued actually. Just we were anyway not taking any new subscriptions in Gulaq Wealth because we knew that we will be coming up with this Gulaq upgraded version, and we have asked all the 20 odd investors who were still with us on Gulaq Wealth. The number was extremely tiny now, so we have asked them to move out and move to the correct Gulaq portfolio or elsewhere, because like you rightly pointed out, Gulaq upgraded does have more number of stocks, which is also true in case of Gulaq Wealth. So while the number of stocks are the same, the concentration of the portfolio differs. And we are anyway doing away with Gulaq Wealth. We are moving to Gulaq Upgraded, and we are recommending that you have a minimum of a lakh rupees. Any which ways our average amount is 2 lakhs. So we'd say 1 lakh to start making sense of the numbers and the returns. Because as you can see, even for a 24,000 portfolio for a 12-year period, the returns will be 27%. This is based on back tested results, whereas it will be 39% for a 2 lakh portfolio. So it, because of course there are fees, there are fixed as well as variable fees that are in the picture, so we have to look at everything to start making sense of the numbers. And over here, if you see what are the after cost active returns of Gulaq upgraded, if you have a 2 lakh rupee portfolio after cost, so we have taken into consideration both the 12 bips turnover fees, which is 0.12%, I'm reiterating, and the DP charges. If we take all of them into account as compared to BSE, you will see the difference between 70, this and this will be 38.9% in 1 year, and it will be around 25% alpha over a period of 12 years, which is still very high because we aren't expecting to generate as much returns for any good investment product. This is just too good. So markets have done quite well. That's why you see these returns coming up. So we need to have realistic expectations, but also understand how what is required for you to do to start making sense of the returns and for this product to start making sense to you. Okay, I think I've spent quite some time on this slide. Now we can move to the next one. Okay, so another important point which is related to this expectation from Gulaq upgraded. You know, when you see these returns, so what does this table tell you? This table is telling you what is the percentage or the probability of outperformance and the probability of underperformance of Gulaq portfolio in different time periods. So, just to give you an example, we see that in a 1 month period, if you are with us only for a month, there is only 66% chance that the portfolio will outperform the benchmark. I am not talking about making positive returns. Positive returns it may still make, but I am talking about outperformance, the difference between our Gulaq returns versus the benchmark returns. That difference is the outperformance. Absolute returns are different. So, again, for 6 months, it is 98%. And for 1 year, the probability based on backtested data and live data, of course, as well, is this much. So uh, what this tells you is that the longer duration that you are invested in the portfolio, will your probability of seeing outperformance increases. And how do we do this? We use rolling returns to do this calculation. So rolling returns typically means, let's say we are doing 6 monthly rolling returns. It would mean returns from, if the period is from January, we will say Jan to July. Sorry, Jan to June. What were your returns? Then Feb to July. Then we say March to August. Then we say April to October. So every 6 month period we take, we see was the portfolio outperforming or underperforming, and we assign percentage accordingly. So again, for the portfolio to start making sense, we have seen that 1 year you will have the maximum chance, and this is data spanning across 12 years. So imagine how many periods of six months of one year you can make. In a 12-year period, it's not 12 periods of 1 years. There are 12 into 11 or 12 periods that we can have every year. So those are the number of periods across which we have seen this data and then collated it to say that again, returns start making sense. Outperformance is seen only if you're invested for the long term. Now look at the table on the right. It says the best 6 months outperformance. So any 6 month period you take, we saw all the 6 month periods and we saw, okay, what is the maximum of the multiple 6 month periods that someone may have been invested in our portfolio. The maximum is 40%. The minimum is 5 minus 5%. So, which means that at any given point in time, if you take a 6 month period, the worst returns over 6 months that you could see is minus 5%. And that may also be the 2% time that we would have underperformed. What is the average? So, for any average investor, so any investor who's been with us for 6 months, what is the average return over time? If you want to average, we will say 14%. So I hope I was clear because these are slightly nuanced concepts. Over here, we are talking about best 6 month performance, worst 6 month performance that we have seen, which gives you some confidence that, okay, this is like the upper and lower limit in which we are operating. And we are not, and the frequency, if you want to see, is this. So, what is the probability of outperforming? What is the probability of underperforming at different time periods? It's over here. So I hope this gives you some insight. Uh, Ankit, anything pertaining to this specific slide, or should I move ahead?
You can move ahead.
All right. Okay. Moving to the next question that we received. Some Kishore says, what is the difference between average monthly churn rate of 92 versus 51% with some examples? So I believe he wants to understand what churn rate firstly really means. Churn is simply, let's say you have a 1 lakh rupee portfolio. A 92% churn would mean that every month we are making you churn 92,000 rupees, which means the sum of buy and sell would be 92,000. Now you divide 92,000 into two parts, it will be 46,000 buy and 46,000 sell value. This is the value out of your total portfolio that you are buying and that you are selling. So 46%, 46,000 rupees worth of shares you would have bought and 46,000 rupees worth of shares you would have sold. That gives you a 92% churn rate on a 1 lakh rupee portfolio. Versus now, when our churn on average is 51%, it means that around 25,000 rupees you buy, 25,000 rupees you sell on a 1 lakh rupee portfolio. So the sum is 51,000. That is the churn rate. How the churn rate impacts you? So as we discussed, there is some percentage based cost that you incur, right? Turnover based cost or value based cost that you incur, which is the variable cost. It includes your STT, it includes your transaction charges, some semi turnover fees. There are few components that you can get more information from the broker. And even on the small case cost adjusted calculator, also you will be able to see the breakdown. So churn has an impact on the variable fees of your portfolio that you are spending. So if the churn has reduced, the variable component of fees that you are paying has also reduced. That is the benefit of the churn, the lower churn. And I just wanted to show you how the churn of our portfolio has looked over the past few months, last 7 months. You will see it was on the higher side till August. September, anyway, we moved into the new upgraded version. So, of course, it will be high because we are moving everything to a new portfolio. And then October, we had a 38, merely a 38% churn, which is very different from what we have seen previously in Gulaq over the last 4 years. So 38% is still on the lower side. The average of the Gulaq upgraded version, which was live from September, is 51%. That is what churn basically means, and the impact, as I said, is on the variable fees, which is a percentage of your turnover fees that is charged on you. That is the difference. All right. Let's move to the next question. Okay, another interesting question. What were the rolling returns and maximum drawdown for the upgraded year 6? So what I've done is I've again given a comparison of the both these figures for Gulaq Live and backtested, which was the old Gulaq version. It was live only for the last 4 years. So we had to take a little bit of backtested data also to make rolling returns. And the Gulaq upgraded, which is purely backtested, it was kind of the changes that happened were only 2 months back. So if you see, first let's look at the maximum drawdown. What does the maximum drawdown means? It basically means what is the maximum fall in a portfolio that you will see from its peak to the lowest trough. What is the maximum fall that the portfolio has ever encountered? So it is slightly higher for Gulaq upgraded, but that is compensated by the lower churn and the higher returns also. The returns are more than slightly higher, I would say. Right? So if you see, if you compare the 3 monthly returns, these are all absolute return numbers, by the way. These are not CAGRs, but absolute return for that set period. So you will see the absolute returns for 3 months, absolute returns for 1 year, and again the absolute, these are again rolling returns. So like I said, if you're talking about 3 month periods, what we did is we took, let's say if you're talking about 2012, in 2012 we will say Jan to March, then we will say Feb to April, then we will say March to May end. So 3 month periods, every month we take, we see, put all of them together, and we see what is the maximum possible that has ever happened in a 3 month period from 2012 till today. That is the maximum. This is the minimum. This is the average. This is for the old Gulaq. For the new Gulaq upgraded version, it is over here. Similarly, when we talk about 1 year rolling returns, old Gulaq maximum has been 119%. For the upgraded version, it has been 140% also. Again, 3 year rolling returns show an extremely stark picture, like even more difference. And this is the 5 year. So, this is the, of course, it's a combination of backtested and live data over here and a lot of backtested data here. But this is what we are showing you. This is how the maximum drawdowns and the rolling returns look like. I think Muthuraman had this question only for the upgraded version, but I've just put both here to give you a comparative. Anything on this, Ankit, so far?
So Sri is asking whether a diversified equity portfolio containing over 30 stock is capable of generating alpha over time.
Yes, why not? Why not? Look, when we talk of mutual funds, you won't really know how many number of stocks are actually present. I like to give this example of mutual fund when comparing it with small case. Because in case of mutual funds, we don't have a lot of information unless we go into their investor presentations and their fact sheets and we study it in detail. So even in case of mutual funds, you could see stocks to the tune of this number at a lot of times, and you won't even know because in mutual funds you just park your money there. The fund manager himself or herself is buying and selling for you, is churning the portfolio, and what you see is just the NAV, the NAV, the net asset value. So you don't know the fees that has been uh, applied. You don't know anything at all. Everything after uh, the net of everything will be shown to you by way of NAV. Over here, it's just that you get to see all these things. You get to see the returns, the fees, the number of stocks. So it's very natural to have these questions. But it is absolutely possible for it to give good returns. The only caveat is, like I showed in a slide previously, you can rewind if you weren't present. What is the amount that you've invested? Our portfolio will start making sense if you invest a lakh rupees. It will start making sense if you invest a lakh rupees, especially if you're also with a traditional broker. Because in case of a traditional broker, the brokerage will be most likely on per script level. So you just need to know whether it makes sense to you or not, whether you are able to invest that much money or not. And if yes, then definitely it will make sense to you.
A lot of people have concerns over the high number of stocks that we have in our portfolio. So they're asking whether we are planning to reduce the number of stocks going forward.
Look, so I just answered this question. What we are doing is, I will also show you something called the cone of confidence in the next slide. What we do is every month, whenever we rebalance, we properly look at all this data, whatever data I'm presenting to you today. And by the way, I'm presenting this because there were a lot of questions. A lot of people got worried that hey, the number of stocks have been increased. So we decided to show you all the data that we track. This is not all. This is just the tracking matrix. There's lots of other data that we track to decide what goes into the portfolio. But to track whether it makes sense, these are the kind of things we look at. There is another tracking mechanism called the cone of confidence that we will talk about shortly. So we keep looking at all these metrics and see if it is making sense. If we get a red flag or a warning signal, we will definitely look at how we can change the strategy or improve it. But so far, we do not feel that these high number of stocks are causing a problem, because in our PMS portfolio, some of you might also be our PMS investors. So Ankit, do you know what is the number of stocks in the PMS portfolio?
About 80 to 100 on an
It,
average.
80 to 100, right? So you have the answer. We have around 80 to 100 stocks in our PMS portfolio, and mind you, it has done better than Gulaq in the last year. It was, I think, around 15-20% more than what Gulaq performed in 1 year time span, and it has 80 to 100 stocks. So high number of stocks, I understand, for a lower ticket size creates a problem. That's why we are saying you wait, you keep adding money, do SIPs so that you're able to reach the 1 lakh or the 2 lakh mark. But it will start making sense for sure at that level. I am also an investor in Gulaq, and almost 40% of my wealth is actually lying in Gulaq. I've also seen a downside in the last 1.5 months, but I'm still sticking to it because I understand that hey, it will make sense. If it doesn't make sense, we will be the first ones to get the warning signal and tweak the portfolio accordingly. We are constantly having discussions internally, monitoring this to see whether it makes sense or not to continue with 36 stocks or to revert back to the old methodology. But that decision will be taken only after thorough analysis. We don't want to keep changing our strategy every month or every 2 months. We felt that we should do this because of valid data, because of valid backtested results, which I'm presenting to you also. So we would want to stick by it and then take a decision. And as I said in this slide, uh, for an outperformance to happen, you will have to wait. You cannot expect that 100% of the times there will be an outperformance, especially when the markets are also going down or are flattish. Because, like I also showed you, you would have seen our Sharp ratio is around, I don't know, maybe 1.5-2%. So risk adjusted return is high, but the maximum drawdown and the volatility, the standard deviation of the portfolio is also high, which means when the market goes up, we will go up more. When the market goes down, we will go down more. But in the long term, we always believe that the market will go up substantially. And that's why, for a longer term, it will make sense to stick to the portfolio and see what it can do. So, yeah, so that's what I wanted to add over here. This was the slide that we were talking about on rolling returns and maximum drawdown. Now I will move to the next slide, wherein this is a very good question, and I wanted to again present some data so that everyone understands this thoroughly. Uh, Tad is asking that in the last 6 months, he has been part of Gulaq Year 6. He's seen a 1% profit right now. Is this normal performance, or he could be timing his payments incorrectly? Very good question. So, firstly, on the right, you will see these are the live returns of Gulaq Year 6 from April till September. These are 6 months. You will see there have been months where it's also 9% and 6%, which is quite high. There are also months of almost 0% and 1 month of -1% when the market was also slightly down. So these are all the returns. Now, if I sum it up also, it comes out to be around 20, or let's say 19%. Now, it's very surprising why a 19%, while we are claiming 19%, let's say, investors, if they are earning only 1%, no one will come to us. They will say, boss, what are you doing? Ye to nahi chalega. So there could be multiple reasons. One reason, of course, is the time of rebalance. Are you rebalancing on time? That is extremely important. Are you being able to rebalance in the first week itself? Of course, there could be luck. Let's say you did not rebalance for 3-4 days and the market fell quite a bit. Then you rebalanced. Market is already down, your portfolio is already down even before rebalance. That could be. Luck does play a role if you are unable to diligently rebalance, but that won't have a 19% difference. For a 19% difference, there has to be something else. Slippage is there, rebalancing timing is there, but what also matters is whether it was an SIP or a lump sum. Now, you will see in case of SIP, the return is less, does not mean SIP is bad in any way. This is just how it is. The returns are still the same. So, what we have done is we've taken two cases and we've taken the year 6 actual live returns. We have taken an example wherein, let's say, the investor invests 24,000 every month with us starting April 2024 in case 1. So this person has invested 24,000 month after month. So the total money put in was 1,44,000. This is A, money put in. The portfolio value currently will be 1,57,000 rupees based on these returns. And based on the time weighted थे in April, उस पे आपको 6 months का रिटर्न मिला होगा which is 20%. जो आपने मई में डाला उसमें आपको roughly 14% रिटर्न मिला है. जो आपने जून में डाला उसमें आपको 9 प्लस कंपाउंड होके 6 और -1, सो इसमें आपको लगभग 14-15% रिटर्न मिला है. जो आपने जुलाई में डाला उस पे तो आपको ये 9 और 6 मिला ही नहीं. जो आपने जुलाई में डाला उसमें आपको सिर्फ 6 - 1 5% मिला. जो आपने अगस्त में डाला वो तो आपका माइनस में ही है. जो आपने सितंबर में डाला वो भी आपका माइनस में है. तो ओवरऑल अगर देखा जाए हर रिटर्न को, हर अमाउंट को हम मल्टीप्लाई कर रहे हैं बाय द रिटर्न इट हैज एक्चुअली गॉट because of the period it was invested in Gulaq year 6, and that is why the return that you generated is almost 14,000, and that's why the return, which is, total return upon amount initial investment money put in, is 8.6%. Now compare this to a lump sum investment of 1,44,000 in the first go. आपका पूरा ही पैसा 6 महीने तक इन्वेस्टेड है. पूरे ही पैसे पे आपको 20% रिटर्न रफली मिला है और कंपाउंडिंग भी हुई है. उसके हिसाब से योर टोटल रिटर्न इज अराउंड 18.4 इन सिंक विद व्हाट वी सी ओवर हियर. सो 18.4% आपको मिला है. नाउ दिस इन नो वे मीन्स दैट लंप सम इज बेटर देन SIP. अगर अगर मान लीजिए लास्ट 6 मंथ्स में यहाँ पे -9 होता 9 की जगह और यहाँ पे -5 होता, तो दिस पर्सन वुड हैव बीन वेरी मच इन रेड and this person would not be in as much red as this person, right? Because we saw that every 6-month period could be different, and the worst was -5, the best was around 40 for the best performing 6 months. So it really depends on the whether you have done an SIP or you've done a lump sum investment. This is something you need to be very careful of when you are evaluating your returns. So while we are stating that, look, we have given you 18% returns in the last 6 months as per our website, it is important if whether you did the lump sum or you did SIP, and if you did lump sum, then did you rebalance timely or you didn't. And let's say both, the answer to both the things is yes. You did a lump sum, you also rebalanced almost in time in the first week, and still you are seeing this difference. Definitely write to us. We will be very happy to evaluate what happened with your portfolio and why the returns are so less. Of course, there will be an additional factor of fees. If it's a traditional broker, the fees will be much higher. So depending on what is the fees that your broker is offering you, returns could be eaten up slightly. But from our perspective, these are two things that you need to be careful of. One, whether it was an SIP, then you evaluate it differently, and whether you rebalanced on time, because that leads to slippage. I hope this was helpful. Ankit, any questions pertaining to this?
Now we can move ahead.
Okay, perfect. All right. Let's move to the next one. Okay, this is the cone of confidence that I was talking about. Now, Sunil Kumar has asked, what if the new strategy doesn't work as per expectations? So this is our cone of confidence, which serves as a tracking mechanism also for us. What does it tell you? It tells you again that based on rolling returns, 1 month rolling returns में maximum, this line tells you the maximum return based on backtested results that our portfolio would have made in different time periods. For 1 month, this is the maximum. Over the last multiple 1 month periods, maximum itna tha. Over the last multiple 12-month periods, maximum 61-62% tha. Over the last 24 periods, 24 month multiple periods, मैक्सिमम आपका 120 से ऊपर था. व्हाट वाज द मिनिमम? यहाँ पे मिनिमम भी दिखाया गया है और मिनिमम लगभग -15 के ऊपर ही है फॉर 1 मंथ, 2 मंथ, 3 मंथ पीरियड. व्हाट इज द वर्स that our portfolio would have performed? Now the gray line is the upside. Upside is basically simply the average. So for example, for a 6 month rolling period, we take all the 6 month rolling periods so far, we do an average, we see कि on an average roughly 10% गया है. We see 12 month periods, we see 20% गया है. नहीं, 20 से थोड़ा ऊपर गया है. And the yellow line is our recent performance. So this just tells you that hey, maximum and minimum is the band. If we go beyond it, then it's a warning signal. If we fall beyond it, it's a warning signal. And this upside also, we compare recent with upside and we see hey, beyond 12 month we are still above the upside also. Below that we are down, but if it continues, then we should look at, then we should treat it as a warning signal and try to relook at the strategy. So this is what this cone of confidence tells us. It tells us that hey, what is our highest and lowest points? What is the band that we have within which we have room to move for the strategy to be doing okay? So all these four lines, they have a role to play with each other and they give us indication on what should be done. So we are constantly tracking all these metrics and then taking decisions. That's what I wanted to really highlight today, because I understand a lot of people in the last 2 months saw markets were down or flattish and we were down. So you need to be aware that one, definitely the sharp is high, it's a high risk product. Gear 6 is a high risk product, it's an aggressive product. And if it's a problem, if you do not have that much of risk appetite, you may want to invest in a gear 5 or a gear 4 or a gear 3 based on your risk appetite and the corresponding asset allocation. There is a risk survey on our website, so feel free to log into gulaq.com. You just have to go there, go to the tools, and take the risk survey to figure if gear 6 even makes sense for you. There will be times when the market is down, the portfolio could fall further. But when the market is up, we have seen that it goes far, far ahead. You know, this particular slide, if I have to show you, see the amount of difference 30% versus 60%. This is what? So 25% versus some 70%. Over here, it's almost 5% versus 20%. So market is slightly up. We were good amount of positive in positive as well. So you need to really see the relative. You need to see whether it is making sense to you as per your investment amount and also your risk appetite. All these things have to be taken into consideration. I think we have seen a lot of data. It has been a very technically heavy session. Now let's come to some other straightforward questions and then we can focus solely on the questions in the chat box. So why is rebalancing done monthly on the first? Sri Datta is asking, wouldn't it be better to rebalance as needed so the portfolio can adjust during market dips? Now my question to you is, what does as needed mean? As needed, who will tell that we need to rebalance it now? It's the fund manager. That's the expectation. Now, for us to tell that hey, now is the need to rebalance, we need to time the market. But if you've been with us since some time, you know that we always say time spent in the market is much better than timing the market, because there are so many people who are trying to time the market, and how many people actually successfully do it? Hardly anybody. All the retail traders, you'll see when you log into Zerodha, you're trying to buy or sell stocks on your own, they'll give you a pop-up, a nudge, which says some 90% of the retail investors have lost money in the markets recently. Why is that so? Because we are trying to see, hey, अभी market, अभी correct हुआ है market, चलो पैसे डालते हैं, या अभी ऊपर जा रहा है, रुक जाते हैं. But how do you know कि अभी ऊपर जा रहा है तो और ऊपर नहीं जाएगा? हाउ डू यू नो करेक्ट हुआ है तो और नीचे नहीं जाएगा? व्हाई डू यू थिंक करेक्ट हो गया अभी डाल दो, क्या पता और नीचे चला जाए? कोविड जैसा सिनेरियो, गॉड फॉरबिड इफ इट कम्स, और भी ज्यादा नीचे चला जाएगा मार्केट. So who decides that it is needed now to prevent us from speculating in the market, trying to time it? We say, okay, we will follow a systematic approach and we will invest on the first of every month. We could have, might as well, we could have chosen the 15th of every month. It's the same thing. One date every month we had to pick. We went with first. If you like 15th, we can do 15th of every month, right? So it's just one date that we wanted to do every month. And why monthly? I've not put that data, but we wrote an article in the past where we showed to the people that if we wanted to rebalance more frequently, which means on a weekly basis, the churn increases quite a bit. आप लोग फीस ही देते रह जाओगे अपने टर्नओवर पे. एंड अगर आप ज़्यादा करोगे रीबैलेंस, इतनी नॉइज होगी मार्केट में कि आपके मूवमेंट्स का ज़्यादा सेंस नहीं बनेगा. Whereas if you, let's say, think of a quarterly rebalance or a half yearly rebalance, it will be so long, the time period will be so much that you may miss out on certain important moves. इतना भी लेट हमें रिव्यू नहीं करना चाहिए पोर्टफोलियो. So the optimum frequency that we thought and we evaluated based again on data and analysis was a monthly frequency. Now, which date of the month? We decided to go with first of the month for convenience. So that's why we do it on first. We don't want to speculate. We don't want to say that, hey, right now is the time to do it. As needed, हमें नहीं पता. Now, Dominic says, what is the best day for rebalancing? If Nifty is at an all time high, is it better to buy that day or wait a couple of days to see if it falls before rebalancing? Hey, how will you see? If, let's say, you wait and you want to see if it falls, and what if it goes even further high up? कोविड के बाद हम जिस लेवल पे थे, हमें लगा अरे ऑल टाइम हाई हो गया, इससे ऊपर कहाँ जाएगा? अभी 24,000 पे आ गई मार्केट. हु एक्सपेक्टेड दैट टू हैपन? So we can't wait to see that it may go up or it if it falls or not. If we wait that it falls, you might as well see if it goes up. So just rebalance when the rebalance comes out. Do not wait, because waiting, unless you are surely aware that the market is going to fall the next day. I don't know, you if you so happen that you know what is going to happen in the market, sure, you take your decision. But as an advisor, we do not know, cannot speculate how the market will go in the future. And that's why we say let's do a systematic approach. Let's avoid any the need to analyze, and the fluctuations will take care of themselves if we do it systematically, methodically every month. Okay, so this was about rebalancing. Now, coming to some market guidance, I think all these questions are very similar. So I'll read all of them and then I'll give a consolidated answer. First one is by Sunny, who says, is now a good time for a lump sum investment or do you expect further market correction? Again, uh, I know markets went down, but so many reasons are there. There could be a possibility of war, there could be something else. Who is to say that market will correct further or not? Now, what should be the investment strategy again in the current market? Should we invest more now or wait? And the third question is, okay, third question we'll deal later. But Sunny and S Khan, both the questions are quite similar. They are saying lump sum abhi करें या फिर हम वेट करें, मार्केट करेक्शन हो फिर करें. देखिए, it's very straightforward. If you have money right now in your bank account, सेविंग्स बैंक अकाउंट में पैसा रखने से बेटर है मार्केट में लगा दो, इन द प्रोपोर्शन दैट इज सूटेबल टू योर रिस्क एपेटाइट. अगर आपकी रिस्क एपेटाइट कहती है कि आप 80% मार्केट में लगाओ, 20% आप डेट में रखो, तो आप 20% आप अपने डेट फंड में लो, आप एफडी करो, आप बॉन्ड करो, या फिर आप 80-20 करना है तो गुल्लक गियर 5 में आ जाओ. अगर आप अपना खुद से डेट प्रोडक्ट नहीं करना चाहते हो तो देयर इज गुल्लक गियर 5 विच विल गिव यू 80-20 रेशियो. But if you want to do your debt separately, that's fine with your 80% money. Then you come to gear 6. Now, whether to do lump sum or not. See, Sandeep, our CEO, he said a very interesting thing. He said, whether to do lump sum or SIP is not a rational decision, it's an emotional decision. Why? You invest your money, you invest, let's say you have 5 lakhs. You put all the 5 lakhs today itself, and then suddenly the next day market falls by 3% and our portfolio falls by 4%. 5 लाख पे 4%, 20,000 रुपये नेक्स्ट डे आपका पोर्टफोलियो डाउन हो जाएगा. You will start cursing us, you will call us up, you will say I don't want to subscribe to you, I will write on social media against you, all of those things will happen. So lump sum में chances are वो हो सकता है. If your reaction will be like that, firstly, can you take that much risk? Are you really a gear 6 aggressive investor? Secondly, अगर आपको लगता है आपको डर लगेगा, सिंपल सी चीज है, if you have the money right now, I would say put it in the markets. How you do it? You can stagger it in very close by frequent SIPs. You know, let's say you have 5 lakhs. You take 5 weeks. You put one lakh every week into the market. So the fluctuations in the market will take care of like your scattered or your fragmented SIP will take care of the fluctuations in the market, and you won't be cursing us because let's say you invest, flip side, you invest 5 lakhs today, market goes up by 3%, we go up by 5%. Suddenly you make 20,000 returns and you're like, wow, Gulaq is the best. You talk positively about us. You know, so you should not get swayed by that. For a gear 6 investor, you need to be aware of how your behavior would be. So that's called behavioral finance, how you will react to it. And if you have a lump sum amount and if you think you're not so risk friendly, you may want to do a staggered SIP, but with a regular frequency, close by dates. But do not sit on money in your bank account because inflation will eat up any returns that you make in the bank account. So there's no point of just sitting on that money. You may also want to explore other products. You feel free to do it. For me, I have 40% of my equity investment in Gulaq. Rest 60% is divided into 3 mutual funds currently. So that's up to you how you want to do, what you want to do with your equity investment. But we also say do not have more than 30 to 40% in any one equity investment product. That's about it. Lump sum or SIP? SIP is fantastic. We've also done an analysis on lump sum versus SIP, and over 20-30 years, the returns are almost similar. Because in case of SIP, the fluctuations are taken care of by the fragmented nature, staggered nature of your investments. So it invest more, yes, for sure. Do not wait because hey, market is correcting. What if it corrects further? Invest more, but in a consistent manner, in a systematic manner. If you have a lump sum money sitting idle in your bank account, invest it maybe slightly stagger karke in the next 5 weeks. Now, the next question is the recommended investment amount is 3 to 4 lakhs per annum for gear 6. Yeah, I would say it is around 2 lakhs, but the more the merrier. The more you do, the fixed cost component becomes even more tiny on your total AUM and the returns become better. Should we continue investing the same amount next year or should we maintain the current investment amount over the next 5 years? See, again, it depends on case to case situation. Definitely, you can continue investing. We say that in Gulaq, up to 50 lakhs you can safely do because beyond 50 lakhs, you may want to get into a more structured product, which is PMS, where ST itself is managing money for you. You don't have to punch in orders every month, you don't have to rebalance yourself. So beyond 50 lakhs, you can reach out to a PMST. But if you have 3 to 4 lakhs and you have money, which is your savings, which you want to invest in the markets, definitely take that money. If you have it in lump sum, put it right now, like I said, in a staggered manner over the next 4 to 5 weeks. If you do not have that money right now and your income is coming every month, do an SIP. And don't put all eggs in one basket. Don't put entire, let's say 3 to 4 lakhs per annum is the overall money that you can save in a year. Don't save all of that in Gulaq. You know, also put some in some other mutual fund, for example, and always see whether you need that money in the short term or not. Short term, say I would mean 6 months. If you need any money in the 6 months, keep it in safer asset classes. Do not put it in equity. So at any time, have around 6 months of your expenses in your bank account or in a very liquid fund which is not volatile. Equity is volatile. Equity will be liquid, but it is also volatile. So do not put money which is equal to 6 months of your expenses in equity. Put it in a safer liquid fund or something like that where you can quickly get the money back in case of a need. I think that was all on the questions. Ankit, anything in the chat box that you would want me to address? I think we are at 7, so this was a long PPT, but I hope I was able to answer a lot of questions of people who had uh, who were getting troubled by what is happening in the markets, and the strategy has changed. So many stocks are there. Like I said, PMS also has 80 stocks. Mutual funds have so many stocks. So just hang in there. Consider the caveats that I have mentioned, and you will be fine. And now over to you, Ankit, for any questions that you think I've not yet covered in the PPT.
Prabhakar is asking, do you have any plans to onboard
Ankit,
the
your voice is extremely low for me. Can you come closer to the mic?
Yeah, Prabhakar is asking, do you have any plans to onboard the Finvesa broker?
Finvesa.
Yeah.
I am not sure of this particular broker. See, because we are tied up with Small Case and Pickrite, we only work for brokers which are on their platform. So any broker which is part of Small Case and Pickrite you will be able to trade through them and invest through them into Gulaq portfolios. So that won't be a problem. And that being said, we are also working on a strategy of our own that is more to do for mutual fund advisory. We will be launching it in another quarter or so. So stay tuned. Some people did express interest in it. Stay tuned, and we will be writing back to you sometime few months down the line. But on the small cases front and the portfolio front, if the broker is part of small case, sure, you will be able to invest. Otherwise, unfortunately, not currently.
Another technical question from Balbir Singh. He's asking, जब भी मैं rebalance करता हूँ तो मुझे बहुत बड़ी amount की notification आती है, ऐसा क्यों?
अच्छा, तो बलबीर सिंह, राइट?
Yeah.
या सो बलबीर जी, देखिए, अभी आई नो ये आ रहा था एंड हमने स्मॉल केस को बोला भी था, बट नाउ नथिंग ऑफ दैट सॉर्ट इज नीडेड. बहुत अच्छा सेबी ने अपना जो रूल था ऑफ 80-20, दे हैव रिवर्टेड इट टू द ओरिजिनल रूल, जिसमें 100% मनी आपको वापस मिल जाएगा. So money, whatever value of stocks you sell today, अगर आपने आज 1 लाख रुपीज के स्टॉक्स सेल करे, 1 लाख रुपीज आपको आज के आज ही अपने बैंक अकाउंट में मिल जाएगा, और उससे आप अपने स्टॉक्स बाय रिकमेंडेशन जो गुल्लक की आप वो खरीद पाएंगे. तो आपको कोई दिक्कत नहीं आएगी. आपको ये नहीं बोला जाएगा कि आपको आज फंड्स ऐड करने हैं, अनलेस बाय वैल्यू इज ग्रेटर देन सेल वैल्यू, जो कि बहुत ही रेयरली होगा. एल्गो शुड टेक केयर ऑफ दैट. इफ योर सेल, अगर आपकी सेल वैल्यू से आप जो भी बाय वैल्यू थी आप कवर कर पा रहे हैं, तो आपको कोई नोटिफिकेशन नहीं आएगी कि आपको मनी एडिशनल ऐड करना है. एंड अगर आपका क्वेश्चन ये है कि लेट्स से आपने इन्वेस्ट ही 1 लाख रुपए कर रखे हैं और आपको बोला जा रहा है कि 1.6 लाख का ट्रेड हो गया, या लेट्स से 1.2 लाख का ट्रेड हो गया, आप सोच रहे हैं ऐसा कैसे हो सकता है, मेरे पास पैसे ही 1 लाख है, मैंने 1.2 लाख का ट्रेड कैसे कर लिया. तो वो ब्रोकर ऐसे ही दिखाता है. लेट्स से आपने 60,000 रुपीज आउट ऑफ दैट 1 लाख, 60,000 के शेयर्स खरीदे, 60,000 के बेचे. तो 60 + 60 इज 120, 120 ऑन 1 लाख इज 120%. सो आपको लगेगा कि यार 1,20,000 मैंने कैसे करे, बट वो हो सकता है अगर चर्न उतना हाई हो, जो कि अब हमारा नहीं रहेगा. अब हमारा जो चर्न है वो अराउंड 50% इज द एवरेज. लास्ट मंथ आपने देखा अभी अक्टूबर 1 को 38% और सो था. सो अब आपको इतनी बड़ी वैल्यू नहीं दिखेगी क्योंकि हमारा चर्न भी कम हो गया है. एंड बिकॉज ऑफ दिस वेलकम चेंज बाय द मार्केट, अब आपको 100% फंड्स मिल जाएंगे. सो देयर विल बी नो नीड फॉर यू टू एड more money on the day of rebalance. You would not even need to go to small case website again to rebalance on the second day. So this is like a good move in favor of the retail investors. Yeah, Ankit.
I think we have covered all the questions.
Oh, okay, great. Okay. Um, are you sure there's no other question that we want to address?
Yeah, I think we have covered all the questions.
Perfect, perfect, perfect. All right then, that sounds great. Thank you so much for everyone for joining. And कोई भी और क्वेश्चन हो आप प्लीज़ हमको, हमारे कस्टमर सपोर्ट एग्जीक्यूटिव का आपके पास नंबर होगा, ईमेल आईडी होगी, मैं दिखा भी देती हूँ स्क्रीन पे. दिस इज़ द सपोर्ट फोन नंबर, दिस इज़ द ईमेल आईडी. Please feel free to reach out to them during working hours, Monday to Friday, from let's say 10 to 7 p.m. एंड ईमेल आप कभी भी किसी भी टाइम पे कीजिए, जब भी हम अवेलेबल होंगे हम आपको रिप्लाई करेंगे. We strive to reply you within 48 hours. We also have LinkedIn, Twitter, and Instagram accounts where we share a lot of our knowledge, where we share reels on Instagram about different finance concepts. So please feel free to subscribe and have a look at whatever we do. And yeah, just stay connected with us. Let us know if you have any feedback. Very happy to receive feedback. There have been people जिन्होंने हमें लिखा भी है सपोर्ट पे फीडबैक देते हुए, प्रेज करते हुए, कुछ ने क्वेश्चंस पूछते हुए, कुछ ने डांटते हुए भी. So feel free to write to us and we'll be very happy to address all your questions. And Ankit, thank you so much for joining today. In the absence of Vivek, you decided to come and join us. So thanks a lot for that. Okay, are you there, Ankit? I can't hear
Yeah,
you.
sorry, I was on mute. Yeah, thank you.
Oh, okay. Perfect. I think that's about it. Thanks, everybody.